Okay, I'll move the next slide.
Okay, and then we finished up our conversation about the Schedule C. And I did see some chats, and if you think we're ignoring you, I focus on the screen, not on the chats, but I did see one chat. It asked about, do we see a lot of Schedule Cs? I forget the percentage, but I know it's probably 10% or less of our taxpayers have Schedule C. So you're not going to see it a lot, but then again, when you do see it, you want to make sure that you ask all those questions that you need to ask about gross receipts. I think that's probably one of the big ones. And then making sure their expenses are actually business expenses. And another thing about expenses, sometimes your clients will ask you, hey, do I need to keep documentation? And I always tell them, yeah, sure. I mean, when you're dealing with governmental agencies, they not only ask you questions, but they also ask about documentation. So sure, there's a requirement to keep records, and there's a general rule. And the general rule is you keep records for 3 years. And of course, there's exceptions to that. But yeah, you want to keep your records. We don't do auditing in VITA. But when we feel uncomfortable doing a return, I have no qualms about it. I'll look at the taxpayer eyeball to eyeball. I'll be pleasant. I won't use profanity. I won't denigrate them, but I'll just say, I don't feel comfortable. And this is why I don't feel comfortable. And then I'll explain what the situation is. And sometimes we have dialogue back and forth. Other times the taxpayer says, okay. And they get up and they take their stuff and they leave. And that's another thing. If you don't feel right about doing a return, and there could be a lot of reasons for it, then just go to your site coordinator or go to the person who's wearing the hat that day in charge and say, hey, I don't feel comfortable. And then that site coordinator or the person in charge will say, okay, well, let me ask some questions, and maybe this is outside of scope, or maybe we don't feel comfortable. And I'll give you an example later about not feeling comfortable when people come to the VITA site and they are unable mathematically to pay their bills based on the reported income. And we've considered non-taxable sources. And that's why I tell them straight up, I said, I'm not going to do your return because it doesn't make any sense. All right, so that's that about the Schedule C. I did see another question about notifying taxpayers once we electronically file. I did get back in that document. I forgot it. I think it was the Pub 1341. So the short answer is yes, we do notify clients or VITA clients if their return has been accepted after we e-file. That's the general rule. And I'm going to ask Christine, our IRS rep, if there's any exceptions to that for the VITA program. That's something that you don't have to worry about. The EROs, the electronic return originators, i.e. the people who e-file, those are the folks who are going to be doing that. All right, John, if there's any more questions, we'll address those. Otherwise, can you go to the next slide? Okay, and so when we talk about the education expenses, we do see a lot of this at the VITA site. And what this means is individuals are going to college. It could be a 2-year college, a 4-year college, or something like that. And what happens is they're paying out of pocket. And that is a definition where they're pulling money literally out of their bank account or out of their pocket to pay for tuition, related fees, books and supplies, and in some cases, a computer. And we'll talk about that shortly. But again, when you're talking about the American Opportunity Tax Credit, it has to be for a qualified education institution, which means you're qualified if the institution participates with the United States Department of Education grant and loan program. And so, for example, not too far from my house, there's an office building, and there's a real estate school there, and they teach people who want to become a real estate agent or a real estate broker. They teach them a bunch of things, and then they take the California real estate salesperson or broker's examination. I'm sure they do a great job, and people get a lot of knowledge out of that school, but it's not a qualifying educational institution. And so it's typically not an issue, but sometimes you might have someone who's going to a beauty school, or I think they call it I can't remember the word. I always use the word cosmologist. But anyway, beauty school, people that do the nails and the hair, that may not be a qualified education institution. And again, your go-to question would be, do you participate in the grant and loan program administered by the U.S. Department of Education? And so we talk about out-of-pocket expenses. This is something it's not super difficult, but you do have to ask some follow-up questions. A lot of times your client will give you that form 1098T, and that's that tuition statement that the schools will issue to the students. And that will tell you most likely most of the story. But they won't tell you the story about purchase of books and supplies. And so that's something you're going to have to ask. And we're talking about school books, textbooks for a class. And then this is something that some individuals can take advantage of. Let's say you've got someone who buys a computer. I'll just use this fact pattern. They buy the computer as a freshman and they're attending one of the local universities here in Orange County. And the computer is used 100% for school because they've got a couple of other computers at their house. And in that case, that computer could be considered an out-of-pocket education expense. And so I do have people at the VITA site that'll ask me, hey, can I deduct my computer? Can I consider that part of qualified education expenses? I have to ask them some questions because some people like me, I've got like, I think 6 computers in my house, and I've got 2 of them dedicated to my business. And so in that particular case, they're business computers 100%. But you might have one computer dedicated to school and other computers dedicated to other things. But if you have one computer and only one computer in your life, then you're not going to be able to deduct out-of-pocket expenses for the entire purchase price of that computer. You're going to have to go through an allocation. And then that will involve some questions. Tell me about your computer use. What else do you use your computer for? And if you have someone who says, I'm all about school and all I do is school all day long, that's all I do. The answer to that would be no, you don't. Because whether you're the president of the United States or you're a rock star or you're a multi-billionaire, everybody has a personal life. And so that means if you've got one computer, you're doing personal things on your personal computer. So again, you have to allocate. And so again, that's that follow-up question. And it's really non-negotiable. You got to get the 1098T. Sometimes they don't have it when they come to the site. And so like I had a young man who came to me and says, hey, can you do my return? Yeah, sure. I asked for the 1098T. Well, I don't have one. I said, okay, well then reach out to the school that issued that one to you and tell them that you need a 1098T because you got to get your taxes done. And yes, there is a little bit of delay, but you want to make sure you get that because that's all part of what we call the information returns that you're securing from the client to prepare a return. And then you have what are called refundable and non-refundable components. And what that means is it's done automatically in the software. The American Opportunity Credit, it will refund a portion of the credit and then non-refund a portion, which means the non-refundable component means it's a dollar for dollar reduction of the tax. Refundable means, let's say there's no tax that's calculated on the return, and the individual is entitled to the AOTC. It simply means that they're going to get money back. And that's the concept of a refundable credit. Okay. One other thing before we take questions. Your IRS publication 970 talks about education benefits. And it is I think it's a very well-written document. It's updated. It talks about all of the all the various educational benefits. And that for me, when I'm working with either a paying or a non-paying client, that's one of my go-to documents when they pitch a fact pattern to me and thinking, I got to look that up. Okay, John, do we have any questions pertaining to the American Opportunity Tax Credit?
Yeah, there's several questions here.
All right, let's see if we can
I'm not sure if you got them. Okay, so if a student is going to a non-qualified education institution, can they still deduct qualified educational expenses like books or
Okay, so the question is, they're going to a non-qualified educational institution. If they are a wage earner on their federal return, the answer is no. If they're self-employed and they're attending some type of educational seminar, I'll use me as an example. So this summertime, I have to get what are called qualifying education credits as an enrolled agent. So what I did, among other things, I signed up for the IRS national tax form. I paid $300 or $400. That goes on my Schedule C. On your California state return, the Form 540, because California doesn't conform with the Tax Cuts and Jobs Act of 2017, And if you itemize, you can go ahead and list certain types of those expenses on your California itemized deductions.
Okay, and the next question is about if you buy a computer for education use, can you deduct the cost, assuming it's for, qualified purpose? Can you deduct it all at once, or do you have to depreciate it over 4 years?
Yeah, and that starts to become a little problematic, but the short answer is if you buy a computer, the general rule is you're going to engage in depreciation, and the general rule for VITA is we don't calculate depreciation. So I think what I've done in the past, right or wrong, somebody comes to me and says, Jerry, I've got a computer. We make a determination, they use it for school 100%. And let's say that I'll make it easy. Let's say they spend $1,000 for the computer. I tell them, okay, the useful life of that computer is probably 3 years. And so if you do the math, then you're probably going to end up with a deduction or out-of-pocket expenses of $333 and change for a year. That's probably the best answer I can give you. And I don't want to get into any Section 179 because now we're definitely we're outside the scope. But that's the short answer. That's how I would handle it. You're not going to deduct it all in 1 year. Anything else, John?
I think Adela asked a question, but I think it's probably similar to that. So we cannot prorate the computer usage. And that's kind of what you were suggesting we do.
Yeah, if someone says they've got one computer, then I put my IRS hat back on and say, okay, well, again, you've got to allocate. It's just like when you have an automobile, you have one car and you're using it for your business. Well, again, we all know that everybody has a personal life, and when you have a personal
Right.
life, that means you have expenditures, and those expenditures have to be accounted for. That's why you have to allocate.
Okay, but then we'd still keep it in scope though, if they're doing that.
Yeah, that's the answer that I'm going to give. And I
Yeah,
probably need to reach
yeah,
out to Christine at the IRS and say, hey, how do you handle this computer thing? Because clearly, if you're a college student, clearly one of your tools of the trade, in addition to your textbook, whether it's a hard copy or electronic, will be some type of device to compute, and we call it computers. Okay, if there are
and
no
then
other questions.
there's one more about, can you assume a school is qualified if they issue a 1098-T?
Yeah, I think the short answer
Yeah.
is I would make a conclusion if
Yeah.
you get a 1098-T from a educational institution, it's going to be qualified. And then keep in
Yeah.
mind, you got 2-year schools, you got 4-year schools, you've got private, nonprofit colleges, you've got private for-profit colleges. And again, all they have to do is just be qualified, participate in the grant and loan program. And that's really not a bridge too far. If you had questions about that, you can do the deep dive in the IRS website to determine if it's qualified.
Okay, no more questions.
All right, great. Let's go to our next slide. Okay, just a couple things, and we touched upon some of these things earlier, but let's run through some other topics. And so, again, we discussed the self-employment tax. This typically is something you have to explain to a young adult. And I'm not making fun of young adults. I mean, I was a young adult too, and there's some young adults that are very sharp and they know a lot of things, and others they're starting to learn things. And so, what you do is you just share information with them. And so, when I meet those young adults and we talk about self-employment, a lot of times they go, "What's that, Jerry?" And I said, "Well, that means you're working for yourself, and that means you're going to have a Schedule C, which means most likely if you have a profit of $400 or more, you're going to pay into Social Security, and that's called that SECA Act that we talked about." The Schedule SC will be generated in the software, and that shows the amount of the calculation. And for self-employed people, when you do the math, it's approximately 15%. But again, as you go through the Schedule C, you'll see how it's calculated. And then you might have some people who are notaries. And my understanding of a notary, they have to be either registered or licensed with the state of California. They just can't wake up one day and say, I'm a notary. You got to go through some training. And notary income, you have to report it on your tax return. And my understanding is there is no self-employment tax on notary income. If someone knows something different, let me know, but that's the last time I heard. No self-employment tax on that. All right, moving on. When you're talking about FICA, again, that's the Federal Insurance Contributions Act. Not everybody pays into FICA. Like, so for example, I teach at a college, and first paycheck I got, I looked at it because, I'm a tax guy. I was curious, and sure enough, there's no FICA that I pay, so I don't pay that 6.2% of my wages because I pay into another system. And you're going to see that from time to time. You're going to have individuals who work for some type of entity, typically a governmental entity, and they are exempt from paying into Social Security. So, for example, my boss, she worked for the IRS for like 42 years, and she never paid a penny into Social Security, which means she's retired now. She will never get a Social Security check. And you're going to bump into people like that. But for most people, they do pay into FICA, and what happens is it's going to be withheld by the employer, and then that FICA tax, Social Security tax, will be remitted to the government. And so you have people who are earning tips in our society. In fact, every time I go outside of my house to buy something, usually it's a coffee, a food product, there's always I'll use the word an expectation of a tip, whether the individual did a little bit of work or a lot of work. There's always an expectation, and typically there's an expectation of a big tip. But anyway, if you're receiving tips for whatever work you're doing, then what you have to do, and I'll give you an easy one. If you're self-employed, let's say you're a hairdresser, like my wife, she goes to a hairdresser, I don't know, once a quarter, something like that. And of course, I'm a curious guy. I ask lots of questions. And I said, hey, do you tip your hairdresser? She goes, yes, of course. I said, okay. And so what happens is that hairdresser who's self-employed reports all of their income, and the income, of course, includes tips in gross receipts. If you're a wage earner, for example, I go to a coffee shop once in a while, and I tip. I generally tip at the coffee shop. And so those tips then need to be reported by the employee to the employer. And when they do that, if they do that right, then it's run through the W-2 wages, and there's withholding for Social Security and Medicare on those tips. So there's no further action that needs to be taken. And then you have individuals who receive tip income and they don't report it to their employer. Well, step number one, they have to report it because it's part of gross income. And step number two, generally, now there's certain exceptions, but generally they have to report the tip income and assess Social Security and Medicare tax on that unreported tip income. And there's a form called a 4137, and I'll make a point to run through that in detail, certainly by next week. I might be able to do it today, but anyway, the 4137 is something that it is within scope in the VITA program. And if someone's receiving tip income, number one, they got to report the tip income, and number two, they have to pay Social Security and Medicare on that unreported tip income. So you can think about all sorts of examples, whether it's someone at an independent coffee shop, maybe, or it might be a dog walker that you tip. It could be that driver. In fact, I had a guy who drove my family and I to the airport recently, and my wife gave him a very generous tip. And I'm thinking, I wonder if he reports that to the employer. And if he doesn't, he should fill out a 4137. But anyway, that's what you should do if you're receiving tip income. And then, although you don't have to go into the Internal Revenue Manual, when you hear that term, what it means is it simply is it's a very voluminous document. And what it does, it's those procedures that the IRS uses to administer tax law. And it also includes information about taxpayer service in the VITA program. It includes information about audits, about collection. And then there's a section in the Internal Revenue Manual that talks about indirect income. So let's talk about indirect income. This is when you are talking to a taxpayer, or when I'm talking to a taxpayer, and I just look at them. And again, I'm nice about it. I don't want to, embarrass them. I just say, I'm not going to do your return. And here's an example. You've got someone who is got nothing in the bank, no money in the bank, and their living expenses are $40,000. Rent, insurance, food, all that stuff. And their income, let's say they're a wage earner, is $25,000. And that you've made a determination there's no non-taxable sources of income. And then once you do the math, then you end up with $15,000. That's the delta, the difference. And then it begs the question, okay, then how are you living here if you have expenses of 40K, your income is 25, where are you getting the other 15,000? And then I've heard this time and time and time again. People say, Jerry, it's not easy. And I look at them and said, I'm a trained accountant and it's mathematically impossible. And so for the VITA program, I say, we're going to have a discussion. I'm just not going to do your return because I'm setting you up for agony if you ever get audited. And that is permissible in the VITA program. You just explain to them, hey, how do you do this? I mean, there's got to be an explanation. And typically it's non-taxable sources of income. But when I hear that it's not easy, I just look at it and said, no, take out my calculator, said, okay, you got to explain this because I'm not going to do your return. Now, as a paid professional, when I work with my clients and they have this situation, I tell them straight up, I said, you are setting yourself up for issues with the federal government, the state government. And so what you need to do, you need to report your ordinary and necessary expenses. You need to report all of your income that's reportable. And I got it. If you have non-taxable sources of income, that may explain that delta. But again, this is something where if you don't feel comfortable, then just say I'm not going to do it, and then bubble it up to the site coordinator, and then the site coordinator will have that discussion with the taxpayer and say, yeah, we're not going to be able to help you. We don't feel comfortable, and I am not going to prepare a return that I feel uncomfortable doing, because based on my background and my experience, I know what happens to these individuals when they file returns like this, and then they get pulled in for state or federal audit. It's very complicated for them. It costs a lot of money. It's a lot of angst, and so you just don't want to set them up. Okay, any questions about unreported income? Being uncomfortable doing a return? I do see a comment. John, can you comment one away? Can you read that comment?
I don't know which one you're talking about.
Let's see. Something about last year. Oh, here we go.
Oh, okay. It just popped up. How would VITA volunteers know bank balances, living expenses?
Oh, you just asked the question. I mean, what you're going to do, you're going to see a W-2 for like $12,000. And then you're going to say, okay, I live in Orange County. I know what it costs to live here, rent, food, insurance, and all that stuff. And I've got someone who lives in an apartment by themselves. Their apartment rent's $2,500 a month. And then again, it begs the question, hey, how are you living? How are you paying your bills on $12,000? Oh, that's easy. My dad, in fact, I had a client like this. I asked the client, how are you doing this? She goes, oh, that's easy. My dad sends me $5,000 a month. It's a gift. I said, okay, that explains it. Okay, let's move on. And so that would be one way. But again, keep in mind, you're not an auditor. You're just asking those questions to make sure you got the picture for your client. Okay, I think that does it then, John. Oh, we got some more questions. Something about looking at last year's return. Yeah, looking at last year's return is important. We ask the taxpayers to bring in their federal and state returns because it's going to have a lot of information on it. Going to help you understand the financial picture of the taxpayer. And the way I look at it in the VITA program, you are actually helping the taxpayer when they say, here's my W-2 for $12,000. I pay $30,000 a year for apartment rent. I think you're helping the taxpayer by asking those probing questions. Well, how do you live in Orange County? I mean, do you have other sources of income? It's okay to do that because again, you want to feel comfortable doing the return, and you will see this. People forget to report certain types of income. Doesn't mean they're bad. It just means they forget. And so you're helping them out. All right, I think that addresses the questions. And any more, John? Otherwise, I'll continue.
I don't see any questions.
Okay. All right. And so moving on to the tax and early distributions. I heard someone say something. Who's that? Phil?
Yeah.
Yes, Phil.
I can't remember. Do we report K1 income?
Do we report what?
K-1 income through the VITA program?
Yes, K1, and when you hear the term K1, that will be from that'll be from either an 1120S, which is a corporation or a partnership. Yes, that is within scope, and there's certain items on the K1 that are in scope. Yes.
Right. I was thinking more from a 1041 if they had that extra income. I couldn't remember if we included that.
I'm going to have to plead ignorance, Phil. 1041, I can't remember. Let me jot that down and look it up on the break. I have to go to the Pub 4012.
Okay.
Yeah, I mean,
Thanks.
there's some items on the K1s that we can't do. I mean, if there's a foreign partnerships or
That is
something like that.
correct.
Yeah,
That's correct. You know, and that's a good point. You're going to bump into documents. I think I mentioned this before. You're going to bump into documents. You can say, well, what the heck is this? And so what you'll do, you get into your publication 4012. If that doesn't answer your questions, go to your site coordinator. We'll have our extra smart books, and we've got some experience. We can reach out to people, but it's okay if you don't know something, because again, the tax world, it's a big, big world. And every season I see a form, an IRS form I've never seen before. And I worked for the IRS for 27 years, and I looked at many, many forms. So there are new forms that come out, and there are forms that you've never seen before. So that's okay. We look it up, and sometimes we have to pitch the question to our VITA rep at the IRS to give us some information. Okay, moving on, tax and early distributions. This is something I have seen time and time again. And sometimes it's a very unpleasant experience. So what happens is somebody is in some type of tax deferred savings program. It could be what we know as a 401k, which is, if you go to the Internal Revenue Code, section 401k talks about deferred compensation. It could be a 403b, kind of like a 401k. It could be a 414. It could be a 457, different types of tax deferred savings vehicles. So what happens is people push off the tax because they call it deferred, and then they start taking distributions typically when they retire. And so what happens is when you take distributions, those distributions are going to be taxable because you deferred the income. And if you take an early distribution, and this is the general rule, there are exceptions. Let's say you're under 59 and a half and you take a distribution, then you're going to pay income tax to both federal and state government. You're going to pay that 10% penalty to the federal government and 2.5% penalty to the state government. And so this is very expensive money. And some people, in fact, I've had a lot of people tell me, well, Jerry, I've already paid the tax. And I said, okay, well, let's have a discussion. You had withholding for federal taxes on your 401k distribution of 20%. They go, yeah, I did. That probably pays their federal tax, probably. Of course, you have to prepare a return. There's probably no state tax withholding on their early distribution. And so they're responsible for income tax and, of course, the penalty. And so what I tell people is, let's go ahead and plug this into the software. Let's determine if you've got certainly the penalty. You're most likely going to pay that, and you're going to pay the income tax on the distribution. And in some cases, they're going to end up owing tax. The general rule, like I say, if you're under age 59 and a half, you're going to be subject to those federal and state penalties. And then there are exceptions. One exception to a distribution not being asserted, that penalty, is if you're disabled, and that's code 3 on your 1099-R. If you get into the publication 4012 on page Delta 44, it talks about code 8 and code 9, which means you're spending your distribution on college or first home purchase. Those are outside of scope as far as the penalty. The only one that's inside of scope is someone who takes a distribution and they don't want to be penalized and they're disabled. And that would be that code 3 that's reflected on the 1099. And that would be in box 7. And unfortunately, you see this a lot. You have people who take a distribution and they get hit with the penalties, which of course are calculated in the VITA program. And they kind of sit there, they scratch in their head, and why do I have to do this? And thinking, well, this is what Congress and what the state of California has put into place. And you've got to pay the penalties if you take that early distribution and you're under 59 and a half. All right, any questions about that, or anybody want to share a story? Okay, nothing more, John?
No, nothing more.
Okay, let's go to the next slide. Okay, oh, here we go. This is the Form 4137. And so when I have conversations with taxpayers who receive tips and they do not report their tips to their employer, which happens, then I tell them they're responsible for paying the income tax on the tips, and then they're responsible for paying Social Security and Medicare tax on their tips. And this is the form that they would use. It is in the software and it's within the scope of the program. And so if you do have someone who's in this situation, then bring up the 4137, populate it in the software, and then they're gonna pay their tax. They're gonna pay their tax. And keep in mind, when someone pays Social Security, and I've seen this a few times, and if you talk to someone in their late 50s or early 60s, they're starting to think about this. And I have bumped into people who did not have what are called qualifying quarters in the Social Security program. Now, the rule is you have to have 40 qualifying quarters in order to receive a Social Security check when you retire. Now, people in their 20s and 30s, they don't care. They're not aware of that. It's not on their radar. But you talk to a 62 or a 63-year-old who doesn't have 40 qualifying quarters, it's all about getting those 40 quarters. And if you have an older individual who's relying on tips that they're not reporting to their employer, this document, once they populate this document and pay Social Security tax, then most likely they're going to get some qualifying quarters. But again, this is the document they're going to use. All right. How about the next slide, John? Okay, some other things, and keep in mind when you're talking about our program, there are many, many tax issues that are outside the scope. And so a lot of times what will happen, I've done this, people have done this, come up to me and I've come up to them, where you've got a situation and you're looking at, say, well, I'm not sure if we can help the taxpayer. Go to the in and out of scope portion in your 4012, and it'll say what's in scope and what's out of scope. And there's a lot of stuff that's out of scope, which simply means you're going to have to tell the person, can't help you. We're not trained to do that. Please go out and seek a paid professional. And that's what you do. But here's a topic that you want to have awareness of. It's called the step up in basis. And as it says right here on the screen, there's a readjustment of certain assets. And so here's the example. You've got an individual who has passed away. That's Ernesto. And Ricardo inherits some stock from some corporation that Ernesto was invested in. Ernesto bought all this stuff about 17 years ago, and it cost Ernesto $16,000. And then there's a valuation at the date of death or near the date of death of 96,000. And so what that means is when Ricardo, he's now has title to the stock, he owns the stock, his cost or basis is 96,000, and that's based on the value at Ernesto's death. And so what that means is if Ricardo then sells the stock, let's say the next couple, 2 or 3 days after he gets it, well, his basis / cost is 96,000. Let's say the stock now is worth 97,000. He sells it and he's going to have a gain of $1,000. So you will see this step up in basis. That's something that we don't calculate. It's really an awareness thing. And you're going to see all sorts of things about decedents. And thankfully, we've got attorneys. In fact, like Phil, he's an attorney, and he would definitely be able to answer some of these questions. But again, we want to stay in scope in the VITA program. All right. How about the next slide? Okay, and then when you're talking about tax year 2022, that recovery rebate credit that we saw in 2020 and 2021, it doesn't exist in 2022. And so when people say, hey, I want to get that credit, tell them, well, you can get it for those previous years, but you can't get it in 2022 because this economic impact payment thing that we went through the last couple of years, it doesn't exist for tax year 2022. And then sometimes people will get confused, and that's why I always use the term tax year 2022, yes, we file that in 2023, but again, you focus in on the tax year that we're working. And in the VITA program, we will prepare returns from previous years. My mantra will be the focus will be the current year. And once we get done with the current year, then we'll do some other years. And in our software, if I remember correctly, typically we'll go back a couple years, which means most likely if people have unfiled returns from 2020 and 2021, and they have the documents, then we can help them with the 20 and 2021. All right,
Jared,
next slide.
just on mine, I usually prefer to do like the old, like if we get 2 or 3 of them to come in, I usually prefer to do the first ones, the older one first, because if there's carry forwards or anything like that, that you could wind up doing the ones later after you have the information from the first. But it's only when you get them simultaneously, right?
Yeah,
That we would
I
file.
think that's a good point. If you get
Yeah.
a stack of papers and the guy says, "Hey, I need 3 returns done," that's probably not a bad idea, starting with that older one. But the focus will be the 2022. And you're right, there are carry forwards, and those carry forwards also include your capital loss, short and long-term carry forwards. That is correct. You're probably not going to see the carry forward for charitable contributions, and I can't even remember if that's in or out of scope. But yeah, that's not a bad idea. But one thing's important: when someone gives you a stack of papers, you're gonna have to go through them, and you're gonna have to determine, do we have everything that we need to prepare the return? And if we don't, then we say, here's your homework, go back and get these documents. But again, I usually focus on the current year. But again, not a bad idea, not a bad idea. All right, how about the next slide? Okay, some other things that you may bump into. We had the charitable contributions last tax year where individuals who took the standard deduction and they made cash contributions, they could actually take a charitable contribution. It was an above the line deduction that we saw in tax year 2021. That doesn't exist for 2022. So what that means is if someone is making charitable contributions in order to take a tax benefit, they're going to have to itemize. That's the general rule. They're going to have to itemize on their federal return. And then keep in mind, you have itemized deductions. You have both federal and you have state. Next weekend, we're going to talk about itemized deductions for the state of California, which can and often are different than the total amount for the federal itemized deductions. But again, charitable contributions is going to be on the Schedule A for 2022. And then life insurance payments, there's all different types of life insurance. And when someone receives we're talking about a beneficiary receives a life insurance payment, their mother passed away, their brother passed away, then when that beneficiary receives those life insurance monies, that's a non-taxable event. So they get the check, they're going to typically ask you, hey, what do I do? Well, do whatever you want with the money, but you don't have to pay any income tax on the life insurance payment that you received. And then there's different types of what is called whole life. Years ago, they used to call it universal life. There's different names for it. What that basically means is when you talk about whole life, it simply means it's a life insurance policy that has a cash value. And some people think it's the greatest thing since sliced bread. Other people think stay away from it with a 10-foot pole. But the bottom line is if someone has a whole life policy, there's that cash value. And when they surrender the policy, there's going to be a 1099-R that's going to be issued. And sometimes you may have a taxable event. And so that's something you want to be having awareness of. But typically individuals have either term or whole life policy. I can't think of any other type of life insurance policy. But when you have a life insurance policy payout, you want to make sure it's in scope and VITA, and then you want to determine what's taxable, what's non-taxable. But again, term life insurance, there's no tax consequence to the beneficiary. And then I think last year we talked about reverse mortgages. Obviously, they're different than insurance. But when you have someone who has a reverse mortgage, it simply means it's an individual who's taken a loan out from a financial institution. And when you borrow money, there's no tax consequence. If you don't pay money back, there could be consequences, but you can borrow money all day long. That's what a reverse mortgage is. You're borrowing money Of course, they set it up where you're getting a chunk of money every month based on the fact that you own property. And then at a certain period, you got to pay it all back, or the bank says, okay, give us the keys to the house. All right. Let's go to the next slide. Now, this is hard to see, and so I'm going to give you a minute if you want, because I will talk about some of these, and we'll also show you on the tax return we're going to do. This is the 2022 1040. We only prepare the 1040 or the 1040 SR. It's done automatically. So if you have a senior that comes in, someone who's 70 years of age, and we prepare a return form, the 1040 SR will be generated. And the SR is simply larger font. It's, again, geared towards seniors, but it asks the same information. It has the same information as the 1040. But again, only one return, either the 1040 or the 1040 SR is going to be filed. And then if you look toward the middle of this form, I don't know, John, can you make this any bigger, or is that as big as it gets?
That's as big as I can manage on mine. And
Okay, well, I'm an old guy. I can see this, but it's a little tough to see. So go to the top of the form on the right-hand side. And there are terms that change all the time. Like when I was a youngster and I'd fly, we had stewardesses. And then one day I jump on a plane and they go, I'm not a stewardess, I'm a flight attendant. I said, okay, well, yesterday you were a stewardess. What happened? Yeah, they changed the name. Okay, got it. And so that qualifying widower, that name has changed, that title has changed. And now it's called a qualifying surviving spouse. And that's the QSS that you see in the upper right-hand corner. And of course, the same rules apply. You have someone who passes away in the year of death. If they want to file a joint return with their decedent, they can. That's married filing joint. And then the next year, actually the next 2 years, if they qualify, they can do that qualifying surviving spouse, the QSS. And then if you go toward the middle of the form, top middle, it says digital assets. And so when you hear the term digital assets, this is what you might have read about, like Bitcoin and some of the crazy things going on. So what it is, it's a currency, a so-called currency, and it's obviously digitized, and people buy and sell that, and they use digital currency to purchase items. And so in the VITA program, if you own digital assets, we can assist you with your tax return. But if you're receiving digital currency for compensation, we cannot help you out in the VITA program. If you own digital currency and then subsequently sell digital currency, we cannot help you in the VITA program. So I'm going to read that statement, and we'll definitely go through it at least another time this session. So where it says digital assets, it says at any time during 2022, did you receive as an award, reward, or payment for services? Or did you sell, exchange, or gift to others a digital asset? And if the answer is no, someone didn't do that, it's in scope. If someone says, yes, I did all that stuff, I received a digital currency because I'm self-employed and that's how people pay me, we can't help them in the VITA program. It's outside the scope. And so that's something that we have to adhere to the rule there on digital assets. You don't want to do that. But that's one of the questions they're going to fill out on the intake form. And then if you go to the body of income, which is toward the middle and going all the way to the bottom, there's a number of changes to the Form 1040. And a couple of the changes are going to be on line 1. You now have line 1A all the way through line 1Z, Z as in Zulu. And so a lot of different items. Most of these things don't apply to us. We did talk about the tip income not reported, and that would be on line 1C, where it says tip income not reported. And that means the tax preparer has to be advanced certified in order to prepare the IRS form 4137. And that again is on line 1 Charlie. And then it also talks about on 1 Golf 1G, it talks about wages from Form 8919. We don't do 8919s. 8919s are different than the 4137. 8919s are uncollected Social Security and Medicare tax on wages, And so if you see someone who has that or wants that to be completed outside of scope, they need to go to a paid practitioner. But the 4137, someone receiving tips, not reporting it to the employer, yes, we can do that in the VITA program. And then if you go down to line 12 where it says standard deduction or itemized deduction, again, you no longer have that line regarding cash contributions. That doesn't exist for 2022. And so these forms, they change every year. And it's not like you have to memorize them. I don't memorize them. I have familiarity with them because what will happen is once you make your entries into the software, the tax return will be generated. You'll have a PDF file. For every one of our taxpayers, we give them a courtesy copy. We print out the Form 1040 and 540, and we give them for their records. Okay, so any discussion about the changes that I mentioned on the 2022 1040? I'm not hearing anything, John.
There's some questions in the chat, and they go back a ways too. So
All right, did you want to
if
take a stab
yeah,
at one?
let's see if, and some of them were directly to me and not posted in the chat. Where can you go to advise a taxpayer to find out how much they have to earn in a quarter to count for a qualifying quarter?
Yeah, what I would do, and I've done this before, of course, this is time dependent. If you're busy, obviously you're attending to the priority. But what you can do, you can go to the Social Security website and you can find out information regarding qualifying quarters. You can also, once you register, you can find out information about your specific account and all of your contributions. And then you can also get an estimate of your Social Security benefits, depending on when you want to take them. And the general rule is with Social Security, the general rule is you take your benefits usually when you're 65. For guys like me, I have to wait until I'm 66 and 10 months to get my Social Security. I knew a guy at work one time, he retired, I think he was 57, and he qualified for a special program with Social Security. So he started drawing his benefits when he was 57. But typically you're looking at 65 or older.
Okay, and this next question has to do with, it's kind of a carryover basis question, which I always have to look up. So the fair market value of death, I don't know if this was talking about the insurance policy or was it maybe just a general asset. The fair market value of death is less than the original acquisition by the decedent. Does the inheritance basis remain the same?
Oh, I don't think I can answer that question right now. I'd
Yeah,
have to think about
I
that.
looked that up.
Yeah.
Yeah, there's a definite answer. I just don't know what it is.
Hey, John, if you can capture that question somewhere and then email it to me, then what I'll do is I'll look it up and next week I can give an example and announce it.
Okay. And then this question, another one that was just to me, can we put that restriction in the document? I don't know what, it's one of those questions that has a reference, but I don't know what it was referenced to. So I'm not sure what that question means. So I'll get you that other question, Jerry.
Okay.
That,
All right. Okay, and I think I've got 11 o'clock. This might be a good time to take a break. But John, before we do, can you advance one slide and show me what we got going on? Okay, so what we'll do when we come back from break, let's go ahead and bring up the Jean Arista Word document. It's a fact pattern for her return, and we'll navigate through that. All right, I'll see you at 11:10. See you in 10 minutes. Non-resident aliens. We do not assist non-resident aliens in the St. Killian's VITA program, but we do assist resident aliens and obviously U.S. citizens. And so if you have someone who's undocumented, let's say they they're from Central America, they come up to California, they're living and working in California, and they have a requirement to file a U.S. tax return. And what that means is they're deemed to be a resident alien for tax purposes, which means we can assist them. So you may bump into individuals such as that. Again, typically they'll be undocumented. And again, we can help them out at the VITA Center. Okay, so in this case, we've got Jean. She's a U.S. citizen. She wants $3 to go to that presidential election campaign fund, and she's going to be head of household for 2022. We've got her occupation. She's both a wage earner and self-employed. That's very typical. You have people who may have a couple gigs and maybe more than a couple gigs. And then in this case, her husband passed away in 2019. So what that means is if she had a filing requirement back in 2019, and if she wanted to file married filing joint, of course, she would sign for the decedent. She could have done that back in 2019. And then for 2020 and 2021, if she qualified, she could be a qualifying widower. But for tax year 2022, she hasn't remarried. We're going to see that she's got a couple of kids that she cares for. And that means she's going to meet the requirement for the head of household filing status. And this is something that you probably want to get in the habit of doing, going to what is called the decision tree in your publication 4012 when you're talking about the filing status. And that's really important. And then sometimes you're going to bump into people, they don't have an understanding of filing status. And so what I do is I actually show them the publication 4012. And I said, well, based on what you told me, this is your filing status. And they look at it and they go, okay. And that usually convinces them. Okay, we're going to cursor down and review the information pertaining to Jean's daughter. Okay, so we have Jean's daughter. Her name is Alma. And we've got her administrative data. And we determined she's a U.S. citizen. And she's over 18, and she's a full-time college student. And so we're going to keep that in mind. She also lives with her mom the entire year. But again, she's a full-time student, so that will come into play when we jump into the software. And then we've got Jean's son. His name is Andrew. We've got her administrative data, and he also lives with mom for the whole year. And that's going to be pretty typical. But if someone only lives a portion of time with mom or dad, then you want to make sure you make that entry in the software. Okay, then we're going to go to the next page. All right, this is information pertaining to Jean. She's employed at a bank. EIN is the acronym for an employer identification number. And we've got her federal and state wages. And I don't know if I can, John, can you see my cursor? Can you see my cursor moving back and forth, or is it just you?
Yes, I can see it.
I can see it as well.
You can see my cursor?
Yes.
Okay,
Yes.
great. And so typically this is what you're going to see. You're going to see federal and state wages. They'll typically be the same. But you should keep in mind in some circumstances, you'll have someone who has to report federal wages and there's no requirement to report state wages. And for me, example, I lived in Cuba one time for about a year and I was required to file a tax return. So I filed my federal return and I had no requirement under state tax law to file a state tax return. So you may see that. You may see that from time to time, but typically your state and federal wages are going to be the same. You usually will have withholding. And a lot of times when people have a W-2 job, they have some type of insurance that's paid for. This goes to what we call the Affordable Care Act. And when people fill out that intake form, they're gonna go ahead and describe their health insurance and different types of way to get health insurance in California. You can go on some type of Medi-Cal, which is a taxpayer paid program for low income folks. And my understanding of Medi-Cal, they do issue some type of card and the taxpayers do not pay any premiums for that Medi-Cal insurance. That's one way to get what is called minimum essential care. Another way to do that is to go through your employer. If your employer offers health insurance, That's another way to get it. Some people call a broker. I did that one time, said, hey, how much is insurance for me, my wife, and my kid? Here's my scenario. Jerry, it's $3,000 a month. Okay, thanks. I'll go somewhere else. That's another way to get insurance. You might have someone who's part of the Veterans Administration and they have some type of insurance. There's many different products out there. So all you want to know, do they have minimum essential coverage? And for the purposes of a California state tax return, they have to have minimum essential health coverage, or they have to meet an exception. And if they don't, then we have to calculate their California individual share responsibility payment or penalty, if you will. So again, that's that. There's also, and I'm not a health insurance guy, but I do know there's a lot of different policies out there. You have policies that only focus on the teeth. You have policies that only focus on the eyeballs, and you have policies that only focus on pregnancy. You have policies that only focus on cancer. Health insurance is what I would call head to toe. So if you have an injury or an illness and you go to a hospital, then your health insurance will cover some or all of the costs that you're going to incur from that hospital and doctors and medical professionals. Okay, then state disability insurance, or excuse me, state tax withholding. That, of course, is remitted to the state of California. And a lot of people who have W-2 jobs will have withholding. Some cases you're going to see a small amount of income and you might not have a whole lot of withholding or maybe no withholding. And then SDI. SDI is something you're going to see not all the time. I think in the last maybe 38 years, I haven't paid a penny into SDI. I've never paid it because I was a federal employee and then I was a state employee and just never paid it. But a lot of people do. And it's withheld by the employer and then remitted to the state of California. And the thing about SDI is when you qualify, you become, like I've seen this example many times. You'll have a woman who is a W-2 employee. She pays into the SDI program, and then she becomes an expectant mother. And eventually the doctor says, hey, you need to take time off from work because the priority is your baby and you. And so mom takes off work. She applies for the disability program. And then if she qualifies based on her SDI payments, she receives a state disability check. And that's a non-taxable check, by the way. And then, of course, the EIN for the state, it's going to be different than the Fed, all be reflected on the W-2. We have a mantra in the VITA program, and the mantra is you're going to key it as you see it, which means you're going to enter the data as shown on the W-2. And most W-2s, it's not a bridge too far. You're going to be able to figure it out pretty quick. And then sometimes you might have a taxpayer with multiple W-2s. I think I had one taxpayer one time that had 6 or 7 W-2s. And it doesn't mean they worked full time at 6 jobs. It simply means they worked. It could be a day, it could be a week, and then they were issued a W-2 at the end of the year. And then self-employment, we have the data here. She's a dog walker and she has gross receipts, total gross receipts of $2,200. And a portion of that is evidenced by a 1099 NEC issued to her for $1,000. And so she's got 2,200. That means 1,000 from the NEC and another 1,200 not evidenced by a 1099 NEC. All right, and we have the address of the company that issued the 1099 NEC, the EIN. The business code, when you jump into the software, and we're going to show you this in a little bit, you just want to find a business code that's either what they do or close to what they do. I have seen it, and I think I did it one time, trying to search for 20 minutes. No, you don't need to do that. The world will continue to revolve on its axis if you get close on the business code. So you don't need to spend 20 minutes. Just find something that is close to what the taxpayer is doing. When you hear the term material participation for the purposes of VITA, you're talking about someone who's engaged in some type of self-employment, and this is regular and ongoing. And so everybody in the VITA program is going to material participate. If you're a paid practitioner, obviously there's a whole laundry list of things for material participation, but we're talking about regular and ongoing. And then for her expenses, the only expenses she had was $100 for supplies. And so no other expenses. So we'll show you the Schedule C for that. All right, let's go to the next bit of information. All right, we have daycare for the son. The kid is 3 years old or so. So she drops her son off at Kitty Place, and she pays Kitty Place $2,700 to watch her son while Jean works. And that's typically what you're going to see if you have someone who drops off their child with a private person. Then again, usually you're talking about some type of certification from the state, and they being the taxpayer, they're going to secure a Social Security number from that private individual to report it in the software. Because what happens is if you're watching kids for compensation, then you yourself most likely have a filing requirement, and that's how the IRS matches people who are watching kids as opposed to people who are paying for people to watch their kid. So it's called a whipsaw effect. So I remember one time I asked my daycare provider, I said, "Hey, what's your Social Security number?" She goes, "Why do you want to know that?" Because she knew I work for the IRS. I said, "Well, I'm not going to look up your account. I can't do that. I want to file this form 2441 for the child and dependent care expense credit, and I want to get that credit on my return. And I need to provide your name, which I know, your address, which I know, and your social." And then, of course, if an entity doesn't have a social, they have an EIN, you're going to plug that in. And in some cases, you might have an undocumented individual who doesn't have either an EIN or an SSN or any type of number, and they're watching your kids. You can still file a return. I can't remember if you can do it electronically, but you can still file. But what you have to do, you have to gather all the data that you can from that individual, which is probably something you're going to do. If you drop your kid off with someone, you probably know their name, you probably know their address, and you probably know their phone number. Okay, let's go to education expenses paid by Jean. And again, we're going to go through this in the software. So we've got Alma. This is that young adult. She goes to the brand new University of California at Mission Viejo. She's full-time, and she's matriculated as a electrical engineering student. And then Jean is the mom, of course. She pays the tuition for Alma. Alma doesn't work. And of course, Jean wants to get that credit on Jean's return. There is a 1099-T that's issued for that tuition that's paid. We have all the administrative data for the University of California at Mission Viejo. Alma receives her books for free. This is something I teach college. I've done it for about 10 years. And what I've seen, not all colleges, but I've seen a few of these colleges where they are providing books for free to students. I teach at one college, and I think it was last semester, every student at the college who was going to school and needed books for their classes, the books were provided for free. They just went down to the bookstore, they signed their name, took the book they need for the class, and it was free. Based on a very large grant that the college got. So sometimes you're going to see that. Now, of course, if you're paying for books, then that's something, again, one of the questions you're going to ask when someone goes to school, what out-of-pocket expenses did you have? And a lot of times they're going to be paying for books out of pocket. So this is the first year for Alma. She doesn't have any drug convictions, and very typical. She paid for a parking pass. Like my son went to Cal State Fullerton, and I was asking them some questions one day. I said, "Hey, where do you park your car?" "Well, I park it in this parking structure." "Okay, how much do you pay?" "Like $450 a semester." I'm thinking, okay, wow. And then he asked me, he goes, "Well, can I take it on my return?" I said, "Well, no, that's not a qualifying expense. That's something that you pay, but you can't include it as part of your expenses." And then she also purchased some season tickets to go to the baseball games at the university. And we will see that's not a qualifying expense. When you're thinking about qualifying expenses, generally you're talking about books, you're talking about tuition and fees, and some related expenses related to the class. So your room and board, you see this a lot. And some people don't know what board is. Board is basically food. And so when I was going to college, I stayed not all the time, but some of the time I stayed in a dorm, and I had to pay for room, my little room and board, my little card. It looked like a credit card. I could go get meals 3 times a day. And so room and board is something, yes, you got to eat, you got to live somewhere, but it's not included in those qualifying expenses, along with the parking pass, along with your, if you're a beer drinker or a wine drinker, that's not included in your college qualifying expenses. So there's a lot of things that are not qualified. And that people may make an argument, some of these expenses that they're qualifying, and you can tell them, no, they're not. Not for the purposes of calculating this credit. You may think they're qualifying, but they're not. And again, just focus on that class, tuition fees, and what's related to that class. And so, for example, I took a class, and this is many years ago, and the laboratory fee was $100, and it was a king's ransom when I went to school. It was a lot of money for me, and that was part of my tuition and fees, my laboratory fees that I had to pay. And then when you see the term check figure, that's an accounting term. It simply means at the end of the day, when we complete the return for Gene, our federal refund should be $7,200. That's our goal. And if we hit it, great. If we don't, we'll figure out what we did wrong. Okay. So with that, John, if there's any questions, let's entertain them. And then we're going to jump to the software.
Do resident aliens have to be resident for all year?
Well, let's see. I'll answer that question as best I can right now. For a resident alien, let's see. Yeah, yeah, that's right. You might have someone who obtains that status during the year. Boy, that's one of those lookup ones because I'd probably give you a wrong answer. Yeah, John, convert that to something, and if you can throw it to an email, I'll look it up. And the reason I'm reluctant is because you have a thing called a dual status alien. We don't do those returns, so I want to give a precise answer. And then, John, with that, are you able to bring up the practice lab?
And I don't know. I don't know if I have my
And if you don't,
password.
what we might
Yeah.
do, we may take a quick break, and if you give me a call, and I'll feed you some information. You can bring it up.
Okay.
Um,
I'm gonna take this thing down because this is gonna be every time I do something.
Yeah,
it
that's
takes that.
okay.
Jerry.
Yeah.
Jerry,
Yeah.
when you're giving the information and talking to them on the phone, mute yourself. You were able to hear your whole conversation last time.
Oh, I'm going to mute everything. You won't be able to hear a peep out of me.
Thanks.
All right. Tell me when you want to take a quick 3-minute break here.
All right, let's take a little break.
Okay, we'll take a 3-minute break so you can look at that. And I'll talk very simple. So this is the practice software that looks very familiar to you if you've done VITA before. And this is the software that you're going to use, the live tax layer program, which looks very similar to the VITA practice lab. So John's going to go to the very top of the document. And he's not going to click on anything just yet. And so when you want to use the practice area, what you'll do, you'll click on that big blue button that says go to practice area. But before we do, we're going to go ahead and cursor down on the document, and we're going to show you a couple sections. And so if you're not familiar with preparing returns, so John, you can go all the way down to the bottom, and that's okay. And then cursor up just a little bit more. Okay, here we go. So the sections that you probably want to spend time with, if you want to get additional experience in practice, is section 4 called preparing a return. And these are tutorials, and you'll open up one or some of them, and you'll get some additional information or training. And then section 6 is the listing of practice returns. You've got a total of 7 that are posted right now. And so what they have is they have a scenario or a fact pattern. You can use that to prepare a return. And in this scenario, it also has check figures. And so you can check your return amounts against the check figures. And so those are probably the 2 areas that you want to spend time in so you can get some familiarity with the software. So what we're going to do now, we're going to go to that big blue button toward the top of the screen, and we're going to click on Go to Practice Area. And then again, this looks very similar to the actual software that you'll be using. And in the program, you have an opportunity to change the tax year. And so what John's going to do, he's going to show you how to change the tax year. You go up there. Now, for the practice lab, you got two choices, 21 or 22. In the real software, it goes back a number of years. And again, our focus is going to be that current year, but sometimes we do get the last year, the last couple years. And so in this case, we're going to stay with 2022. And John's not going to click anything, he's just going to show you with his cursor. When you want to start a new return, you would go to Start New 2020 Tax Return. You click on that. I'm feeling adventurous, John. Click on that. Let's jump in here. Let's jump into that. You got a brand new return. He's going to make up a social, let's say 400 633. And then let's go ahead and plug that in. 6333. And let's see if that's been used before. He's going to go all the way to the bottom. And it has not been used before, so good to go. So we're just going to show you real quick. In this case, this is a message from the software folks, and it's a work in progress. They continue to fix it. They continue to update it. Okay, hit continue. And then this is how you actually get into a return. And then you start with your filing status. If you are working with the return, either as part of your certification or you are preparing a live return, keep in mind you've got that decision tree for filing statuses in your publication 4012, or you can go to that filing status wizard. And there's all sorts of documents out there. I recommend the 4012 as your starting document. Sometimes you go to that publication 17, but keep in mind there are hundreds and hundreds and hundreds of documents that you can use, not for filing status, but for tax information. Okay, so I am now sufficiently bored. So at this point, John, if you can hit save and exit, and let's exit that return. And then we're going to go to client search. And so once you've made entries into the software, then you go to client search, and you're going to be able to find your various returns that you've played with. And so in this case, I've made entries for Gene Arista. So let's go ahead and open that up. And he's going to hit select. And then we're just going to walk through the entire return, and then we'll entertain some questions and we'll show you what we've done. So what John is going to do, he's going to go to the left-hand side, and he's going to hit where it says basic information. And then we're going to start off with that first tab that says filing status. So again, filing status, usually this is not a bridge too far, but you want to make sure you ask the question, you use a decision tree. In this case, I've made a determination that Jean is filing head of household in tax year 2022. She's got 2 kids. She's taking care of them. She's paying the bills. So she gets that head of household filing status. And you can see where the software has already been updated. Now they use the term qualifying surviving spouse, as opposed to the qualifying widow or widower that we used to use. Okay, we're going to hit continue. And then we're going to ask John to just slowly go through this administrative data that we populated. And some of the mistakes that everybody will make, sometimes you're going to have a transposition of a letter or a number. And but again, you're going to capture that data on the intake sheet. We're going to look at the Social Security cards, the occupation, she's a bank teller. And then John, if you can stop here, a lot of times you're going to have taxpayers who want to contribute to that election campaign fund. Keep in mind, it will not change the refund. It will not change the amount that they owe. This is essentially an order by the taxpayer to the federal government to separate or segregate $3, drop it into this campaign fund. And then again, going back to that term qualification, if a candidate qualifies and you have to do certain things to qualify, then you can knock on the government's door and say, okay, I've qualified, give me some money to run my campaign. So that's what that means. Blind and deceased, you see this from time to time. I think I shared the story about a year or so ago. I was interviewing a VITA client via Zoom, and I'm taking notes. She's showing me documents. And then finally she says, Jerry, you probably don't realize that I'm blind. I said, I was about ready to ask that question because, we got to go through all these questions on your intake form. She goes, yeah, I am blind. I'm completely blind. I have no sight whatsoever. I said, I understand that. I said, okay, then what's going to happen is I'm going to indicate that in the software and you'll get an additional amount on your standard deduction. So you will see that from time to time, but you want to go with what is called the tax definition of blindness. You'll find that in the publication 4012, and then your taxpayer is going to have some type of medical documentation it'll either be from an ophthalmologist, which is a medical doctor that specializes in eye care, or an optometrist, and that would be someone who's not a medical doctor, but they do specialize in eye care. If you have an optician, I don't think that counts. I don't think opticians do that. I think it's either an optometrist or an ophthalmologist. Next, taxpayers deceased. Unfortunately, we see this from time to time in VITA. I see this a lot where we'll have a sister who will pass away, and then the brother will be the only one who's around, and he will get the refund on behalf of his sister. Or you might have a parent a parent who's lost a son or a daughter, and then they're filing a return. So you have to indicate that the taxpayer is deceased. When that happens, when the return is filed, then the IRS makes note of that in their master file. And then, of course, if someone tries to file a return using that deceased individual's social security number, like, the next day, the IRS will reject that return. But my understanding is social security numbers at some point are recycled, but we're not going to discuss that here. We don't do combat zone, and that's that item that says you serve in a combat zone. If you've got a military veteran, whether they're active duty or reserve component, and they go, hey, I was in a combat zone, say, yeah, we can't help you at our site at St. Killian's, refer them to a site that assists taxpayers who are either active or reserve component. And I know that our college does it, Garden Grove, Coastline College. We have military certified folks. Okay, here's that question about digital assets. Did you sell, exchange? Did you gift? Gifted means you gave a digital asset to someone. And in this particular case, if you've sold it, that means most likely, because digital assets are considered property, you most likely will have a capital gain, or maybe you have a capital loss. We at the VITA site cannot assist you with that, but you got to ask that question. And then the one toward the bottom, we have a lot of taxpayers speak different languages. Like, for example, my first language was not English. And so if you have someone who grows up and they want to talk to the IRS in a different language, then all they got to do is say, IRS, please go ahead and contact me in this language. John, can you humor me and click on that and see what pops up where it says written communications? Okay, so, and then if you select that, you have a laundry list, and it's not all the languages, but it covers a fair amount of languages. So, okay, we can unclick that, please. All right, then we have an address down here, and we got a local resident, and we've indicated we've got a California resident. We only do, if someone wants their state return completed, we'll only complete a California return, and it will be that full year return. We're not going to do a part year return. We're going to do a California return. So sometimes people move into California and they go, hey, can you do my Illinois return or my Nebraska return or Iowa return? And the answer is no, we don't do that. You're going to have to find a paid practitioner. And this is something about, if you know anything about paid practitioners, they purchase software, and their software that they purchase, they're able to prepare any state return that has individual income tax. I think there's like 45 or 46 of them. And so a paid practitioner can do that. But again, we don't. We only do California in the VITA program. All right, can you go to the bottom?
Looks like we
John?
have to add a number here, right?
Let's see, if there's no number, yeah, put in 1, 2, 3. All right, we're gonna go to the bottom and see what it says there. Okay, phone number will capture that. All right. Now, of course, we do get emails. So if you get an email on the intake form, you want to populate that. What we do as preparers, sometimes quality reviewers, and sometimes the EROs, electronic return originators, we will reach out to the taxpayer when the return needs to be perfected. There's a boo-boo, there's a mistake on the return. And I've done this many, many times, mistakes that I've made, mistakes that other people have made. Call up the taxpayer, say, hey, Maria, can't get your return to electronically file. Let's go through some data here. And then we run through the data. Oops, okay, someone has transposed a number. Okay, and then hit continue. All right, we talked about the filing status, personal information. Let's talk about dependents. Can you open up the dependent tab? And we're going to open up where it says edit. That means information has already been entered. And we're going to open up the Alma Arista tab. The blue pencil opens it up. The red garbage can deletes that particular entry. And sometimes you'll make entries and it'll be so garbled. You'll say, okay, like we said when we were kids, do over, hit the red garbage can and re-enter data if you need to. Okay, we've got this information. Again, social security cards are important because, like, for example, if you ask me, Jerry, what's your son's social security number? My response to you would be, I don't know. I got to go look it up. I don't have it memorized. I don't even have my wife's social security number memorized. I know mine, but that's it. So social security cards are important. If you have someone who has a document from the Social Security Administration, then of course that will be okay. So for example, the United States Social Security Administration, they issue all different types of documents. And so what that means is if a document has a Social Security number on it, that means you can use that as opposed to a Social Security number. Hold on a second, my printer's going crazy. Give me 10 seconds. Okay, and so that's it for Social Security numbers. That's the general rule. We're going to get that Social Security card or a document from Social Security Administration. And then most people will have either an SSN or what we call an individual taxpayer identification number. That ITIN is going to be a number that the taxpayer will apply for if they're ineligible for a Social Security number. Then the IRS sends a letter to the taxpayer. Dear taxpayer, here's your ITIN. You can use this to file returns. And then the ATIN, that's the adoption taxpayer identification number. You don't see that very often, but if they have it, then you'll enter that data. If you go just a teeny weeny bit below there, John, you see that description. It talks about U.S. citizens, U.S. nationals, U.S. resident aliens. In my tax travels, I see lots of U.S. citizens. I don't see a whole lot of U.S. nationals, and I see a lot of U.S. resident aliens. A U.S. national, give you one example. Let's say you got somebody from the Northern Mariana Islands, somewhere out in the Pacific. That would be considered a U.S. national. You don't see those folks very often in the VITA program. You're going to see a U.S. citizen or a resident alien. Okay, we'll wait until you go back, John. Okay, and then of course we're going to indicate the relationship. John, can you do the drop-down menu in the relationship box where it says daughter? And so here's your laundry list. And typically it'll be a son or a daughter or maybe a grandchild. Okay. And then the number of months. In this case, this child lives with mom for the whole year. And then we've indicated that this young lady, her name is Alma, she's over 18, she's a full-time student at one of these educational institutions. And all of this other data below does not apply. And then do keep in mind when you're trying to determine if someone has a dependent, they're either a qualifying child or a qualifying relative. And so if you get into your publication 4012, you're going to see that. And sometimes you're going to have someone who doesn't qualify as a qualifying child, and then you default to the laundry list for qualifying relative. And if they qualify as a qualifying relative, that means you've got a dependent. And of course, the whole thing about dependents is you've got tax credits associated with a dependency. And so that's why we spend time with dependents. Okay, we'll hit continue. And then we're going to open up the Andrew. And that's her young son. He's about 3 years of age. Same concept. He's got a social. And what I remember, maybe it's done differently now. I remember when my son was born, there was some lady, and I don't know if she was an employee or a volunteer or what, but she was literally trooping the line in the maternity ward, and she'd come up to either mom or dad. Usually it'd be dad because mom's going through a lot delivering a baby. And documents were completed, and Social Security numbers then were issued shortly thereafter. Not the same day, but shortly thereafter. But anyway, most people who are eligible get their Social Security number at a very early age. Okay, let's cursor down. And we've got son, and then we've got, he lives with mom the whole year. And then this is a little kid, so he's not going to college and he's not making any money. Okay, hit continue. And then, of course, if you had additional children, I think the most I've ever had, I had a guy who had, I think 17 or 18 kids. And so on his tax return, then of course you'd keep adding kids, add a dependent or qualifying child. But typically in our VITA program, I think we see maybe 2 or 3, maybe 4 kids for a taxpayer. Let's hit continue. And then let's go to continue. So we're done with basic information, but what I do want to do, John, can you open up that IRS Identity Protection Personal Identification Number, the IPPIN? And so sometimes you'll have a taxpayer says, yeah, I had my identity compromised. I got this letter from the IRS. And what that means is you can electronically file your return if you have that IPPIN. If someone stole your identity and you don't have an IPPIN, then it might get rejected, your return. You can still file the return. You'll have to go through a process with the IRS. But a lot of people, like my sister, had her identity stolen. My brother, he had his identity stolen. And so they both called me at different times and go, hey, what do we do? I said, well, just get one of these IPPINs and then you can electronically file. And so you have to fill out a form. You can do it online and you get a letter sent to you and then you can file electronically. Okay, let's cancel out of that. We don't have that. And then we're going to go, we're just about ready for a break, but let's open up the W-2. Let's get something done here. And then we're going to go ahead and use that blue pencil to open it up. And just a couple things. Most people have a standard W-2. Sometimes they'll get a corrected W-2. I think I told you the story. I worked as an IRS employee, and the IRS issued me a W-2 and it was incorrect. And so I went back to payroll and said, hey guys, can you fix this? And they go, yeah. So they fixed it and they issued me a corrected W-2. So if the IRS will do it to me, they'll probably do it to, they being the employer may do it for someone else. So you're going to get corrected W-2s. It's just going to happen. Substitute W-2s, that would be where someone doesn't have the information and they have that pay stub that has a year-end information. And then you can essentially recreate the W-2 with that year-end pay stub that has income and withholding information. All right. And then let's cursor down a little bit. Employer, the mantra is we're going to key it as we see it. And so we've got, oh, John, throw in 123 Mockingbird Lane. Okay. EIN is the employer identification number. Sometimes when you put in the EIN, you'll have auto population for the employer name. Okay, that's great. So we have that data that's been entered for our taxpayer. Let's cursor down a little bit. And so this is what you would call your money slide. You want to make sure that this agrees to the W-2. So we have wages. And in this case, I know because 1, 3, and 5 are all the same, I know that she does not have a 401k through this employer because there's no tax deferral. If there was tax deferral, box 1 would be smaller than box 3 and 5. And then on most, not all W-2s, but on most W-2s, you're going to have withholding, federal tax withholding. You're going to have on most W-2s, Social Security tax pay, that's box 4. And then just about on all W-2s, there might be an exception or two, there's going to be Medicare tax that's paid. And so all of those, again, you key it as you see it. Let's see. Yeah, box 10, dependent care. That means there's monies provided. This is a fringe benefit, and you can get into your publication 4012 regarding fringe benefits, or there's an IRS publication 15-B that talks about fringe benefits. And when you're talking about fringe benefits, there's a laundry list of fringe benefits, and some of them are taxable, and some of them are not taxable. And so you can get into your Pub 17 there. Let's go to box 12. And John, if you can open up box 12. So you have a lot of different codes, and I don't have these codes memorized, but they are listed in your publication 4012. The two codes you're going to spend a lot of time with would be DD, Delta Delta, and that would be the health insurance premiums paid by the employer on behalf of the employee. And then John, can you open up box 12 again? And then you can see D as in Delta, that would be deferred compensation. And again, we talked about those plans, a 401k, a 403b, a 414, a 457, different types of tax deferred plans. And then can you show Q as in Quebec in your laundry list? This is for your military folks. So again, if you have a military guy or gal, just refer them to a site that prepares military returns, which means military certification. It's not difficult, but you just have to go through some reading and then take the certification. Okay, that's the only one we have, just the Delta Delta. If you go to box 13, you're going to see statutory employee. We typically don't deal with those folks. Retirement plan. We're going to key it as we see it on the W-2. And in this case, she does not have a retirement plan. Okay, we're going to go to box 14. Box 14 is your California SDI. And if you open up that code box, let's take a look at that, John. At the very top, it says California SDI, and that carries forward to the Schedule A. If you have someone who itemizes, this is a tax. This is something, it's a compulsory item, which means it's a tax. So it will go to the Schedule A itemized deductions. And then again, if you qualify, if you pay into SDI, and when you become injured or disabled and you qualify, you can get a disability check from the state. And I think that's all about that. Now, not everybody pays into SDI. You're going to see people who don't pay into it, and that's just the way it is. There's some people who are exempt. Okay, let's go down to California. And then again, you've got we're just going to do California. The EIN is going to be different. Your state wages will typically be the same amount as federal wages. And then typically you're going to have some type of state income tax withheld from the check. And of course, that will be populated. Once you enter that data, it'll be populated on the California return for the amount withheld. And then local wages. I think I did one return a couple years ago. I don't know if the guy was from New York or someplace, and he actually had local wages. So for example, the city of New York has a individual income tax. And so if you are preparing returns in New York City, you got to prepare a city return, a New York State return, and a federal return. And for the city return, it would be box 18, 19, and 20. There are no jurisdictions in the state of California that have an individual income tax. None, not even San Francisco. San Francisco does have some type of business tax, but not an individual income tax. Okay, we're going to hit continue. And then before we take our break, we'll entertain any questions, John.
Let me scroll up a bit. There was a question. I answered some of them, but can an address be a PO box?
Yeah, because like,
so.
for example, my dad, he lived in I guess you'd call it a rural area. And the there wasn't even a mailbox out front, and the mailman or the mailwoman wouldn't stop by. So he had to go into town and get his mail through a PO box.
Can
If
I jump
if
in?
I recall
Jerry?
correctly for California, that you need to, when we fill out for California, if you have a PO box, you need some kind of real address. But that's just my
Yeah,
recollection.
I mean, if you got an address, I'd put
Yeah.
it in, but quite frankly, there are some people that, they don't have a physical address, so you put in what you can. Now, if you put in what you can and you cannot electronically file and you don't have a physical address, then that would be a paper return.
Can I jump in, Jerry? It's Phil.
Oh, sure, Phil.
If the person owns a home and they don't want to put their home address, explain to them that, that could create an issue with capital gains taxes, because if they're reporting a different address than they claim when they sell the house and they're trying to use the $250,000 exemption, it's going to trigger an audit.
Yeah, that's a good point. And I would say if you've got a physical address, put it on your return, because it's not like you're, avoiding the state. I mean, the state already knows where you live, because when you buy
Yeah.
something, typically you're going to record it. The deed's going to be recorded. So yeah, just use a physical address if you got one.
Yeah. Tell them if they don't put the physical address, it could cause more capital gains tax when they sell their house.
Yeah, absolutely. Okay, anything else before we take a break?
Is there an issue if the taxpayer W-2 doesn't match their current name? If you get married, what I said is, put in the W-2 as you see it, right? See it as you key it.
Yeah, the mantra is you want to key it as you see it. And when you get married, marriage is great, I think, for most people. But when you get married, and if you want to change your name, because some people do and some people don't, but if you want to change your name, you have to take an affirmative step. And I think you got to go to Social Security and say, hey, I want to change my name. It used to be Wilma Flintstone. Now I want it to be known as Wilma Flintstone James. And then you do that through Social Security. And then once you get that new Social Security card, then you're good to go to use that new name.
Okay, and then the next question was, if we have time, can we talk about the reasons, next steps on the dependent, if the dependent earns more income than 4,300?
I will make a note here, and that's something that we can tackle, because next week we're going to spend a lot of time in the software. So we're talking about a dependent who makes more than 4,300.
Yeah.
Sure. Yeah, we can do that.
And then the other question was, I think I answered this one, but we may want to check too. Will the software ever populate the codes with the description? I don't recall that the codes, like the box 12, all those codes. I don't know if there's
No.
a description. I was just looking at the 4012, I think, or you just Google it, right? It's pretty easy to find.
Not to my knowledge. So what that means is you're going to key it as you see it from the W-2. If you're curious about a code, you can find those codes listed in the publication 4012. You can also find them listed in actually the instructions to the form W-2. But just key it as you see it.
Yep, someone mentioned that as well. And next question is, California SDI subject to the 10,000 K tax limit?
Need more data on that. If you're talking about paying SDI of $10,000 or more, we don't see those clients in the VITA site, but I think there's a limit to SDI.
No, but I guess if you would combine it with the other items, right? If you got a $10,000, right? We have the cap on $10,000 deductions, right?
You're talking about this. Yeah, the SALT limitation.
I think that's what it is. I don't think it's subject to
the state and local tax limitation, that's at 10,000 on your federal return. On your state return, see if I can do this in memory. That would be considered a tax, and I think that's going to appear on your itemized deductions if you itemize on your California return.
So what you're saying, it probably is subject to the limit.
I'm going to answer that question this way. Next week, we're going to go through the itemized deductions for California.
Yeah, I mean, it's a federal question, right? It's whether or not the $10,000 limitation.
As far as the federal, your state and local taxes, and that includes your income taxes, And that includes other types of state and local taxes, because you have income taxes and other type of taxes,
Yeah,
all part of that $10,000 limit. SDI is not an income tax. It is not. It is a
and it's not a
tax,
property,
but
and
it's
it's not a property tax because
not a
again,
property tax. It's an
yeah.
occupational tax.
Okay, all right.
All right. Okay, good, good dialogue. Anything else before we take a quick break?
Don't see anything else.
All right, let's come back in 10 minutes and we'll finish up the Gene Arista return. So we have completed the W-2. And so if you had someone with a second W-2 or more, then you would simply click that add a form W-2 in the upper left-hand corner. But in this case, we just got the one W-2 for Gene. So now we're going to go ahead and hit continue. And we now will go to that 1099 NEC. So John's going to open that up. And you see, you've already made an entry, so we're going to go ahead and do this. And what happens, the software prompts me to add this to the Schedule C, which it did. So we go to the very top. We have the administrative data for the 1099 NEC, the entity that issued this to the taxpayer. There's a payer TIN, taxpayer identification number. We got the recipient, and we've got her, throw in her address. Okay. And then we'll cursor down. If there's an account number, we'll enter that, but we don't have that. So non-employee compensation, again, when you hear that term, that means they're not a wage earner. Wage earners are issued a W-2 and they have withholding. If you're non-employee compensation, that means you are most likely a self-employed individual. And in this case, $1,000 that she was paid. There's no tax withheld. And so we're done. And that's going to be added to the Schedule C as in Charlie. And let's go to our Schedule C. If you can go to the very top, John, and let's talk about basic information. You don't see a lot of Schedule Cs in the VITA program, but you see enough of them, and it's certainly within scope for the most part. If they have a DBA doing business as, you'll enter this data. If not, you'll leave all that blank. And we'll cursor down. Your business type, you want to get a code that's close to what they're doing. And let's see, John, if you will click on business codes, let's go down to that 812990. There we go. It says all other business. And you can see this is a laundry list. It's if you want to go through the whole thing, it'll take you quite some time. But if you go down to 812990, you'll find other services. And again, it's a laundry list. Okay, 812, there we go, 812990. And as my brother said one time, good enough for government work. I'm happy with that. And so let's go ahead and go back to our screen. We've indicated that that we picked that number. Back to our basic information. And again, back to the business type. Okay, so we're good to go there. We hit continue. Then we go to questions about the business. We're not going to make any changes here. We don't deal with cash basis taxpayers. We don't deal with inventory, so you can leave that alone. That material participation is already checked for us. That means regular and ongoing for our purposes. And that's it. And so we'll hit continue and move on to our next tab. Our next tab is income. And you can see that the $1,000 at the very top, it says total income from 1099 NEC. And then it says this value will be automatically added in. So don't include it on the line. And so the remaining amount, she had a total of 2,200. So the remaining amount would be 1,200. And so when you look at the Schedule C as in Charlie, your total gross receipts should be that amount. I guess if you want to put it, but we've already entered that data. So for the 1099. All right, so we'll go ahead and hit continue. We're done there. And then let's go to, let's just show you this so you don't do this. Like in the line of the movie, you see that road down there? Don't use this one. Okay, so open up cost of goods sold. We don't do cost of goods sold in the VITA program. So if you find yourself in this particular slide, tell the taxpayer, I can't help you, and then hit cancel and get out of this. You don't do cost of goods sold. That's for a retailer. General expenses, you'll see this a lot, various types. And you just have to remember ordinary and necessary. Is it reasonable in the amount? And is there a business purpose? And typically what will happen, your taxpayers will come in with a piece of paper and they'll have some little scribbles, or maybe they've typed it up. And then you just want to review it and confirm what these items are for the taxpayer, and remembering ordinary and necessary. Okay, and in this case, I think she had some supplies. Yeah, down there. So she's a dog walker, maybe little treats or little chew toys that doggies chew on. Okay. All right, let's go ahead and hit continue.
I was gonna say, Jerry, sometimes like I usually like when I have supplies, you click on this thing here
Mhm.
and then you can kind of describe what they are.
Sure.
So
Yeah. Yeah, you can do that.
kinda-
Okay.
it's weird how
And
it,
so
it
let's go.
tops me back. I gotta get
Okay.
general expenses,
then-
or do you want to, or we're done with that?
Let's go to car and truck now. This taxpayer
Okay.
doesn't have any, but we want to show you that slide. And so you can see right here, this is someone who has a vehicle they're using in their business, and it asks for a description. So, whatever, Chevy S10 pickup truck. When you place it into service, the date, enter that data. And you can see on the screen that the dollar, let me restate that, the cents amount, or the amount that's allowed per each mile, is different for the first half of the year from the second half of the year. And you can see there in that box, it says business miles before July 1st and business miles after the 30th. And so you'll enter that for your business traveler. Commuting is going from your house to your place of work. It doesn't matter if you're a wage earner or self-employed. And other miles, I think just about everybody has other miles. They go to the store, they go visit their friends and family, they go to church, they go to the laundromat, they take a trip to Vegas. That would be your other miles. And then the check marks down here, there's 4 questions. Typically, your clients are going to answer all of those. They're typically going to have the vehicle available for personal use. They can use it whenever they want because it's their vehicle. Everybody has evidence of some kind. When you gas up, you get a receipt. When you get your tires changed, you get a receipt. When you pay your DMV bill, you get a receipt. And yes, it's all written, whether it's written in an electronic format or on a piece of paper. So generally, you're going to have those check marks for your VITA client. All right, you hit cancel out of that. And then just as a reminder, we do not calculate depreciation on a vehicle or an asset. Depreciation is a cost recovery. That's something, if they have assets that they depreciate, just tell them to go to a paid professional and they'll calculate depreciation expense for them. We don't do business use of the home. Same thing, you have to refer them to a paid professional. Okay, we'll hit continue. We'll go to our next topic. And continue. And now we're going to go over to the extreme left-hand side. We're going to click on child care. We're going to open that up, and we'll open up this particular document. This is Form 2441, and you can see total expenses paid by mom is $2,700, and you can see the child care provider. Typically, it's going to be a corporate entity, or if it's a private individual, then you'll enter their social security number, but that's a dollar amount. That's not the amount of the credit. That's the amount that's used to calculate the credit. And again, for tax year 2022, this is a non-refundable credit. Okay, can you cursor down a little bit more? Okay, and I think we've entered the dependent. We'll open that up. Step 2, and we can see Andrew, that's the 3-year-old kid. Okay. And then we'll open up 3, and we don't have to add any more. If we had another kid, then we'd add a qualifying person. Okay, you can hit cancel. We're done with all of that. No changes are needed. And then we can go over to the left-hand side for education credit. We're going to open this up. And so we have two different credits. Of course, the larger credit, which is both a refundable and non-refundable component, is the American Opportunity one. Lifetime learning, this is for typically individuals that don't obviously qualify for the American Opportunity. And the lifetime learning credit is smaller than the American Opportunity. And lifetime learning is also non-refundable. So here is your go-to, what I would call the box where you really got to get this right, qualifying expenses. And this would be the out-of-pocket expenses that the taxpayer has incurred. And that would be for tuition, related fees, books, or in some cases, maybe a computer. So that would be qualifying education expenses. So we plug that in. We've listed the name of the educational institution. That'll come right off of the 1098T as in Tango. And so now we'll cursor down a little bit. And then it asks you a series of questions. Did they receive the 1098T? Yes. Was the 1098T from 2021 filled in and box 7 checked? No data there, so no. Federal ID number, right from the 1098T. It talks about the Hope Scholarship. That's the old name for the American Opportunity Credit. And so what that means is for each student, they're allowed a total of 4 years. They don't have to be consecutive for the American Opportunity or the Hope. And so if they went to school 10 years ago and they took the Hope for a couple of years, and now present day, they're eligible for 2 more years of the American Opportunity Credit. So 4 tax years for each student for this credit. They got to go at least half time. The college is going to designate what's at least half time, not the student. And then it talks about, did they complete 4 years of post-secondary education? Post-secondary education is defined as college, university. In this case, no. And then we cursor down to where it says, were they convicted? It's part of the tax law, so you get asked the question. I think it's social engineering, but there's a lot of social engineering, but it's part of the tax law. So we ask the question, the answer is no. And then we ask about the eligibility. And in this case, the answer is yes. And so when you go through this form, make sure you answer all of those questions. Let's hit continue. Okay, we're done with the American Opportunity Credit. Let's open up the Earned Income Credit. And let's kind of show you what this is all about. So it asks for, excuse me, it asks you for due diligence. What the heck? Let's do due diligence. It says, was the taxpayer a non-resident alien? The answer is no. It says, was a taxpayer a qualifying child of another person? No. Did you complete the return based on the information provided to you? Sure, yes. Did you interview the question about their head of household filing status and their eligibility to claim the credit? Yes. And this is, did you review the information to determine the taxpayer is eligible? Yes. And then the next question, it says, did any information provided in connection with preparing the return appear to be inaccurate, incomplete, or inconsistent? Well, you're trying to ask the questions to avoid all that. So the answer is no. And taxpayer retention, we don't have to worry about retention. We don't worry about retention in the VITA program. We file the return, and there's certain documents that are kept in an archive, but we don't keep documents. We don't keep them. So the answer is yes. Next question, it says, you can ignore that. It says, did you ask the taxpayer whether they were eligible? And yes, we did. Now, this is important. Someone mentioned looking at past year returns. So if a person has been disallowed a credit or it's been reduced in a prior year, you got to ask that. In this case, the answer is we did ask, but there was no change. So the answer is yes. And then ask about credits reduced, and the answer is no. And then we'll hesitate for just a moment. If someone did have their credits change from a previous year, ask about the disposition. Was it disallowed? Was it disallowed in full? What is the situation? Keep in mind, if you file for EITC and you engage in what is called basically fraud, then you're not going to be able to take EITC for 10 years on your federal return. So it's a draconian punishment. If you were just careless, it could be a 2-year suspension, so to speak. Okay, next question. Did you ask questions about a Schedule C? Yes, we did. Next question, is the child a qualifying child in someone else's return? No. Mom takes care of both kids, so the answer is no for Alma. EITC had asked about, have you determined they're eligible? Yes, we did. We asked all the questions. Did we explain they may not claim if the taxpayer did not live with the child for over half the year? Okay, yes. And then tiebreaker rules, we're not going to get into that, but for instructional purpose, we're going to say, yeah, we did. Child tax credit, yeah, they reside with mom. And yes, we did explain all of that information to the taxpayer. And we did explain all of the rules. If you have a divorced individual, then what you have to do is you have to go through your publication 4012. You have to determine if the taxpayer qualifies. So you got to ask those questions. American Opportunity Credit substantiation was submitted, the 1098T. We asked about books, so the answer is yes. And then head of household, you probably remember this from your reading. It says unmarried or considered unmarried for tax purposes. So you can have a married individual, and we'll pick on the husband for now, and he's out of the picture for a year or two. He's not around. He's somewhere else, and he's not communicating with his wife. In that particular case, if the wife meets all the other rules, then for tax purposes, she's considered unmarried. So in this case, yeah, she was unmarried. She lost her husband. Hector passed away about 3 years ago. So we'll say yes for this one. So what, there we go, John. And then did I certify? And the answer is yes. All right. Any more questions? And we hit continue. And then let's go over to our side. And okay, it says answered. Okay, great. So we can hit continue. We'll leave this blank. Hit cancel. Now, John, before you go anywhere, when you're talking about actual tax preparation, you'll see a screen similar to this. And what this means is you're going to indicate the amount of the refund, how the taxpayer plans to receive the refund, whether it's a paper check or whether it is direct deposit. So when you click on that, a lot of our clients want direct deposit. So we simply ask them for their account number, their routing number, checking or savings, and then the name of the financial institution. And for direct deposit, typically it takes anywhere from 5 to 7 business days, and that means the weekends are not counted. And then for paper checks, it can take many, many weeks. And so if someone's brave enough to get a paper check, they're simply going to have to wait. It's not going to happen in a couple days. All right, the 8879, down there, we ask all taxpayers to sign it. Then we e-file after they sign that. In some cases, if you go up a little bit, John, in some cases, your taxpayers only want a state tax refund, a state tax income tax return to be filed. And can you cursor down a little bit more? Cursor up. And up a little bit. Oh, there we go. And so sometimes they only want the state return to be transmitted. If that's the case, we indicate that. We click there. But typically, we're going to file the federal and a state return. Okay, now we're going to go ahead and just showing you a little bit. When you get to the VITA site, we're going to have little sessions, if you will, when we go through the live tax slayer program, so you can get some experience. Let's go to health insurance. And so what happens is when someone has health insurance, and they should, that's California law. If they don't, they have to meet an exception. One of the exceptions would be they have insufficient income. They are at the poverty level. If for some reason they're not in Medi-Cal, they're not in Medicaid, they're not in affordable care through Covered California, you're going to see all sorts of stuff. But the bottom line is you ask about health insurance. And if they're in Covered California, you would check yes. And if they're not in Covered California, you would check no. Covered California is a program for people who want to purchase insurance, health insurance, and it's subsidized by the taxpayers. And if they do if they do enter into the Covered California website, number one, they're subsidized. Number two, they are required to file a tax return. And so that means federal and state. And they will receive documents from the state of California. They will also receive the IRS Form 1095A, which shows the amount of premiums that they've paid and the amount of subsidies that they've received from the taxpayers. In this case, no, she's covered at work, so we'll hit continue. And then this is for our practice lab. The state returns have not been loaded. And so when we're ready to, if you want to practice when they're loaded, you can do that. But when we work with the live system will have obviously California loaded. Okay, we're done there. Let's go ahead and open up our returns. So if you can hit summary print on the left-hand side. And then, John, if I remember, I don't think we're going to be able to display the view print, but you know something? Maybe it will this time. Hit view print. Let's see if we can get it to generate a PDF that you can show the crowd. And then hit print your 2022. Let's see what happens. Okay, I see it. So that's good. Okay, so let's run through this to kind of give you some familiarity. This is a document because this is also used by practitioners. It's set up. But again, we don't charge for the VITA program. This just shows the various documents that are associated with the 1040. Okay, we'll cursor down a little bit. And then the second page is the roll-up, which has the administrative data and the various forms. Okay, let's go to the next. And then this has a roll-up of your federal or quick summary. And then more of the summary. Let's go to, now, of course, the program will replicate or produce a facsimile of the W-2, the data that you entered. And so there's your W-2. Okay. And then let's go to the NEC. This is the NEC, another facsimile based on the entries for her dog walking. Okay, go to the next one. So this is the document that all taxpayers will sign. We'll have them review this, sign it. It has the amount of refund or the amount that they owe. And then you can see there's a signature block toward the middle. And if it's a married filing joint return, then you have to have both the husband and the wife signing the 8879. This gives our VITA team, or electronic return originators, it gives them the permissions, if you will, to electronically file. And so, like, for example, in my practice, when I meet with my paying clients, I do all the work, I give them the 8879, and I tell them, when you sign it, I'll go back to my office and e-file your return. If you don't sign it, then your return remains unfiled. So they sign it, we file. And if you go to the bottom of that page, you're going to see our ERO information, something you don't have to worry about, but it has that data in it. Okay, here's the 1040, and you can see that she's filing as a head of household member. And let's see, we've got her address. We have the digital asset item checked no, so we can help her out with the return. We have her 2 kids listed. One, of course, is 18, so for tax year 2022, that credit for other dependents, that's that $500 credit, is going to be reflected. And then little Andrew, who's a 3-year-old, mom's going to get that child tax credit for her young son. All right, so you can see, and I don't know if you can make that bigger, John. Is that a bridge too far? Okay, that's pretty good. Yeah. And so, how about make it smaller now. Little minus sign. Perfect. And so now we have the wages, which are reflected on line 1 alpha. And then you can see what I talked about earlier, line 1 Bravo, Charlie, Delta, Echo, Foxtrot, Golf, Hotel, India, Zulu. So you have all, these are different from the 2021 return. And that's what happens. The returns are reformatted for whatever reasons. And so you want to have some familiarity with that. Okay, line 1 Zulu is going to be the total of wages and all those other lines. And then we go to other income, that 2,100, we're going to talk about that shortly. Then we have our adjusted gross income and our total income. And then we have our adjustments, which would be the 1/2 self-employment tax adjustment. And then when you hear the term adjusted gross income, which is line 11, it simply means income less adjustments to income. And that's your adjusted gross income. And then your standard deduction, in this case, she takes standard. If you look to the left-hand side, head of household, this is for a head of household filer who is not blind and who's not over 65. If they're blind, according to the tax definition, or if they're over 65, then of course they get an additional amount to the standard deduction. You can see line 13, that's that very generous deduction. It's 20% of the net income. It's called a qualified business income deduction. And then at the end of the day, everything spills out on line 15, taxable income. And then if you go to the next page, and so when you talk about taxable income, the software goes in and they look at two things. They look at taxable income and they look at filing status to determine the amount of the federal individual income tax, which in this case is $1,768. And there's also some self-employment tax because she had a Schedule C, and that's approximately 15%. And that's on line 23. And so you can see that all of her individual income tax has been offset by a credit. And that's why the only tax that she's responsible for on line 24 is that self-employment tax. You do not offset self-employment tax with your non-refundable credits. And then on line 25, that's the amount withheld. And sometimes you'll have withholding on a 1099. And that shakes out to line 25 delta. And then you see the other credits, earned income. This is the federal refundable, the additional child tax credit, that's that refundable portion, and the American Opportunity Credit, that's that refundable portion. And so all of your refundable portions, and of course your tax withheld, that totals line 33, 8,576. And so the difference between that and what she owes, 296, is the amount of a refund, 8280. In the VITA program, most people want to have direct deposits, so that refund section will be filled out with a routing and account number, and then the type of account. And if you go to the bottom of this page, John, then you'll see at the very bottom which says paid prepare. Well, for the VITA program, it'll have St. Killian, and then it'll have our site identification number, which is called SIDN, S-I-D-N. And it will also have a phone number of a responsible party at St. Killian's that the taxpayer can call if they have questions. Let's go to the next page. This is Schedule 1, and you can see it has a number of things on it to include that business income. This is the net income from the Schedule C. And if you go to line 8, other income, you will sometimes, and we don't have anything for this return, but sometimes you're going to have gambling winnings. You might have cancellation of debt. There are certain cancellation of debt that we will take care of in the VITA program. You might have jury duty pay. Another one is that prizes and award. A lot of people, they get some type of prize or some type of award that's a taxable event. Most prizes and awards are taxable, some are not. If you get into tab D as in Delta in your 4012, you'll see those items that are not subject to income tax. All right, we'll go to the bottom of this page. And you can see the amount on line 10, that's at 2,100 net income. Now we're going to go to the next page. This is the continuation of Schedule 1, and now you have adjustments to income. So you have income less adjustments equals AGI. And typically you might have educator expenses. It's gone up to $300 maximum this year per educator. So if you have a married couple that are educators and they qualify, they can get $600 as an adjustment to income. The reservists, performing artists, and fee-based government officials, typically you don't see that. But if you do, then that would be, and you're qualified to do it, that would be the Form 2106. Let's see what else. Your 1/2 self-employment tax, you're going to see that a lot. You're going to see line 15 a lot for those people that have Schedule Cs. Alimony paid, I've seen this from time to time. Alimony, if you look in your tab D as in Delta, it depends on when the divorce was. So if you got a divorce from 10 years ago and someone's paying alimony, they can deduct that alimony on their return. And then subsequently, the person who's receiving that alimony from that old divorce, that's a taxable event. New tax law, let's say they got divorced and everything took place after 2018, then they don't report the alimony that they received and they don't take a deduction for alimony that's paid. Another thing you'll see is line 20. If someone wants to deduct their individual retirement arrangement and they qualify, they can take a deduction on their return. There's limitations. And then that student loan interest deduction, you're going to see that from time to time. And then if you go down to line 24 alpha, jury duty pay, what that means is if you receive jury duty, step number one, you're going to report it as a taxable event. And then if you relinquish your jury duty check to your employer, some people do, they have to, then you can take an adjustment to income. And so the net effect is 0, but mechanically you go through reporting it and then taking the adjustment. Okay, next slide. Additional taxes, this is self-employment. And keep in mind, when you talk about the tax world, we have individual income tax and there's different types of taxes. Typically in the VITA program, the only other tax you're going to see is a self-employment tax, typically. Okay, let's go to our next page. Okay, and that's just the roll up. Okay, all right. And then we go to the additional credits and payments. This is where you have the child independent care expense credit listed on line 2, non-refundable credit, that dollar for dollar reduction. And then your education credit, that's from her daughter going to college. Mom pays tuition, so mom gets it on her return. Okay, let's go down to the next one. And the next one is continuation. The Schedule A does appear. We recognize that she gets a standard deduction. And so this does not apply, but it's still generated. What I do in my private practice, if I have a standard deduction, I physically remove this document from the package because the taxpayer doesn't need it. But anyway, it's generated part of the package. I guess we can give it to the taxpayers in VITA, but it doesn't do anything. Here's your Schedule C. This is really important. You want to make sure the taxpayer has an awareness of gross receipts and all of the expenses that they've incurred. And then a lot of times taxpayers will start scratching their head and say, wait a second, if you would go to the expense section, they'll look at this and they'll say, yeah, I've got some additional expenses. And so, John, if you can cursor down to part 2, and then this may jog their memory. They go, you know something, now that I look at this, I did have some insurance that I had to pay for whatever. I did have some other supplies, or I did have some other repairs. Understood. You make the changes, you update it, print out a copy for the taxpayer, have them sign the 8879. They're good to go. All right, next page. This is that self-employment tax document. A lot of people have no issue with this. They understand it. Certain young adults, they've never heard of this. So you just explain it to them, say, this is for self-employed people. You're paying into Social Security, you're paying into Medicare. And if you can cursor down, John, then you can see that calculation. So mechanically, what happens, you take the net income, you multiply it by 0.9235, and then the amount that remains, you subject that to the Social Security and the Medicare tax rate times 2. Again, it's about 15%. Okay, next slide. This is at 2441. This is for the child care. And so mom pays $2,700. That is not the credit. The credit is going to be based on the amount of the child care payments. Okay, we cursor down to part 2. You go through a calculation, you can read that for yourself, but the bottom line is she's going to get a portion of that. And if you go to the very bottom, you should see, there we go, line 11, your money line, credit for child and appendix care expenses, non-refundable credit, which reduces the individual income tax dollar for dollar. EITC is the next line or next document. This is federal EITC. Next week, we'll have to use the 2021 software to show you the state EITC. So we've got 2 kids, and you remember the rules. They got to be under 19. And so both of them qualify. And this is just all the information that's populated. One's a student, under 24, one is not. Okay. And then we got some more pages. This credit for qualifying children, this is for Alma, the 18-year-old. Okay, next. I stand corrected. Child tax credit. This is for the little kid and the 18-year-old daughter. Okay, next slide. Okay, just the computation. And don't fall into a trap. If a taxpayer wants you to go line by line through the entire return, your response should be no, that will take about 8 hours, and we will not do this. If you have a specific question, you can address those questions. I will typically show the taxpayer page 1 and 2 of the 1040. I'll show them the amount of the refund or what they owe. And then if they want to ask specific questions, we can get into that. My paying clients in my practice, the one guy asked me, hey, Jerry, can you go through the whole return? I said, yes, I can. I'm going to charge you $200 an hour. It's going to take 8 hours to go line by line. He goes, okay, Jerry, what do I owe? This. And that's the way it is. It's just impractical to explain each and every line to a taxpayer for a 40, in this case, a 35-page document. Next slide. This is your education credits. Again, there's 2 of them. And at the very top, it talks about that refundable component of the American Opportunity Credit. And there are limitations, and you've read about them in your publication 4012. Okay. Cursor down. This is the information that you entered regarding Alma's college and the administrative data and the fact that she had a 1098T. And if they don't have a 1098T, they can go back, they can reach back to the college and they can get one. Okay, cursor down. This is that 20% business, qualified business deduction, a generous deduction reflected on line 15, and that's 20% of the net income. Okay, cursor down. This is a paid prepare due diligence checklist, and I don't know what it's going to look like for the VITA software that we're going to get, but if we have this, then we will answer the questions. But if you are a paid preparer, you will have to go through this. Okay, we'll cursor down. And that's just more of the due diligence. Okay, cursor down. That's a credit limit worksheet. This actually are all of the credits that are non-refundable, which offset that individual income tax. Okay. And then just more of the calculation. Okay. And okay. Pending information. And sometimes you will make notes in the software, and you'll, in fact, what I'll do, I'll make a note here to go through notes in the software next week, and that would be for a tax preparer. Okay, so we don't need to worry about this. This is for paid preparers. We're not paid preparers. And this is a calculation for EITC. We've already gone through that, so we can go through this. And I think we're at the end there. Okay, thank you, John. So real quick before we leave, next week is December 17th. We will have a session. We're going to spend most of our time going through the software for a scenario, which will include the state return, the Form 540. If the 2022 program has not yet populated the state return, we will revert back to the 2021 for instructional purposes to get some familiarity with the state. and we'll talk about dependents making money. We'll talk about the K1 from the various entities. We'll talk about that fair market value regarding that step-up basis that we talked about, and any other questions that are posed to me. And so I think that does it. I'm gonna turn it back to Fred or John if they have any closing comments.
Nothing for me. There's one question, Jerry. A couple actually. One, I think this is talk about filing just a California return. Can you file a California return only without computing a federal tax return? I think the answer is no. You got to compute it at least as a pro forma.
Yeah, I would say the answer would be no.
Yeah. I mean, you have to compute it, and maybe you have to attach a pro forma even if you don't file it, right? You can file a electronically a California return and then do a paper return, right, for federal separately.
I guess you could, but the way I would do it is I
Yeah.
would compute everything on the federal side of the house.
Yeah.
And then I would tell the client, okay, if you want me to email or excuse me, to e-file your state return, I'll do that. But yeah, I got to complete the federal return because I refuse to prepare a tax return with paper and pencil. I can do it, but I refuse to do it. It takes too much time.
I meant paper filing, not a paper prepare.
Oh yeah, paper file, because
Yeah.
once you enter all the data, then you hit print for your client, say, here's a return, send it off to the franchise tax board. Yeah. All right. How about Fred? Is Fred still with us?
No further comments there.
Fred, who's winning? Is Navy winning or Army winning?
I'm not watching either.
Okay.
France
Okay,
is winning.
folks, that'll do it. And then again, I'll try to address all those questions that have that been popped up. And next week, our focus is going to be the California return, which will include covered California entries for that. And we'll talk about itemized deductions for the state of California. And we'll do at least one scenario, perhaps two scenarios. That's all I have, John.
Okay.
Thank you.
All right,
Thank
take
you.
care, everybody. Bye-bye.
Thanks, Jerry.
Thank you.